How's it going, Itay?
Happy Halloween. Spooky CPI readings.
Incoming. I know it's been a wild roller coaster. I feel like we're getting years of movement every few weeks now.
That's typically how bear market goes. Massive volatility intraday, intra-week, intra-month.
That's a lot to handle. Well, excited to dig into what's been an action-packed recap of what's happening in markets and a bit about what you think is coming looking forward. I'm Tori. I'm the CEO, co-founder of Equi. I have with me our esteemed CIO, Mr. Itay Vinik. I'm very grateful and excited to hear what the charts have been showing you. I hope that for this spooky season, you can read the crystal ball and give us a better sense of what's in store.
I'll do my best. So since we have a lot to cover, I'm just going to hop right into it. As Tori mentioned, we are Equi, making elite investing accessible in our diversified funds that have done pretty well this year, I would say. All right. So market update, Halloween 2022. And I like to start this as I've started most market calls this year. And we've been looking at a chart of the S&P 500. Really, this is the December top or January top, rightly at 4,800. We've fallen over 1,000 S&P points since. And we've had multiple rallies in this bear market. It's been very, very choppy. You can see 9% here in February, 13% in March, another 10% in May, a stunning 20% almost, 19% in the summer. And all of them have just fallen apart and went to new lows. And, you know, that's what bear markets are really famous for, giving the investors hope that that's it, that's the bottom, and then just taking it away and just crushing their dreams one at a time. Now we're getting another 11% off the bottom. And the question is the same question we've been asking all along. Is this it? Is this the bottom here? Or is just one more of those bear market rallies that's soon to be wiped out? We'll try to answer that question today as a part of this analysis. And yeah, I mean, bear market rallies tend to be very, very sharp and very vicious. So, you know, we've been following that all year.
Yeah, the fangs of those bear markets. Sometimes it's actually the bear has kind of taken the teeth out of the FANG stocks, right? You've been talking about that lately.
That's right. But you know what bear markets are really famous for is that actually no one makes money, because the shorts end up getting squeezed and losing money during these rallies, give up right around the top, and then the market falls again. And that's kind of how that works. Nobody's able to make money in these markets, or very few people can. Okay, so the Fed balance sheet is still the main driver. I know a lot of people are talking about rate increases and how the Fed is raising rates so aggressively. I think that the balance sheet and the liquidity of the Fed is even more important than interest rate increases, just because it's had such a tight correlation to the S&P over the years. So what you can see here is the total amount of assets that the Fed holds in blue, and the S&P 500 starting in 2008, and the trajectory of the market with that liquidity that the Fed produces has been very, very strong. And 2022, we have seen the Fed balance sheet starting to drop, and the S&P has followed. The S&P really topped just before the Fed balance sheet did. Very interestingly, the periods where Fed balance sheet was contracting had a lot of volatility and a lot of upside, and then periods of balance sheet expansion tend to have upside in risk assets. This is what the market's really worried about. Not necessarily this little drop here, but the projection of the Fed balance sheet is for a drop from almost 6 trillion here to 4 trillion. Pretty substantial reduction in the Fed balance sheet into 2024. And the market's really pricing in some of that. And, you know, it's very hard to fight the Fed, right? You don't fight the Fed on the way up, and you don't fight the Fed on the way down.
Is there any sort of historical precedent for that level of tightening?
No, but there is for 2018. You can see here this in the dot plot here. That was the trajectory of the Fed back then in the first quantitative tightening experiment. In 2018, right around here, into early 2019, the market fell 20%. You can see that that's COVID. So it's actually right here into this drop. And the Fed folded. So the Fed projected this, but as you can see, that actually didn't happen, and the balance sheet started expanding. And my very strong suspicion is that we're going to see something similar here. We're not going to really play out this entire drop. I don't think that the Fed can allow that to happen, but more on that down the line. With the mortgage-backed securities, we see a very similar situation. The Fed is reducing the supply of mortgages, but it's actually not even at the current trajectory of what it's supposed to be. The Fed is having a really hard time contracting it in an already imploding mortgage markets where mortgages are over 7% already, and there's no liquidity at all. And the Fed is having a hard time getting to targets. Just imagine where mortgage rates would be if the Fed is able to get rid of all of those. The housing market wouldn't look so pretty. So again, something that I don't believe the Fed is necessarily able to fully execute on. So there's a lot of pressure on the economy so far. And what's interesting is that nothing really broke yet. Nothing material as it is. When you think of bear markets, like the bear markets of the past, we think about things like Lehman in 2008. We think about things like Enron in the early 2000s, and typically there's some big company that goes bankrupt, or some kind of credit event that really is the climax of that bear market. And so far, we haven't seen any of that, which makes me believe that we're not really at the end of this bearish cycle yet until something really breaks. What would it be is anybody's guess, but we're seeing signs of pressure massively increasing. So here you can see the mortgage rates for the housing market. It's exceeded 7%. So again, what that led to right now is that the mortgage market index is at multi-decade lows. We haven't seen such low mortgage activity since really the late 1990s.
Wow.
And the housing market is just frozen. So an easy way to think about it is that if your budget was $1.5 million for a house a year and a half ago, for the same paycheck that you're getting with the new mortgage rates, your new budget is closer to $850, $900. That's all you can pay.
Wow. So demand it's definitely put a damper on demand.
However, supply is still, they still don't want to sell. So the seller's like, okay, I'm just going to wait. So housing prices are down a little bit, but they're not down nearly as much as what demand destruction would suggest, at least as of yet. And one of the key questions is that would the labor market collapse at some point, which will force the sellers to sell? And that's really the $1 trillion question, because right now it's still holding.
Well, a low rate mortgage it's the new golden handcuffs, right? You can't leave.
Can't leave. I know I can't leave. I have a 2.75% mortgage.
Right. Why would you?
Exactly. So it's a much bigger factor than just price. And similarly, on corporate America, we're seeing some pressure as well. This is the yield on high yield corporate bonds. So what that means is that when corporations, in a little bit of the lower and middle tier, they want to borrow money. In 2021, they were able to borrow money for 4%, but now it's close to 10%, 9 or 10%, where you can see here, it's not far away from the COVID highs where we had a massive financial crisis. It's nowhere near 2008, 2009, when it got to 20-some%, when it seemed the whole world is about to default. However, it is putting a lot of pressure on companies, corporations, and massively increasing the rate in which they're borrowing. And that will slow down the economy. So remember, all this monetary policy is acting in a lag. And these things are happening now, but it takes multiple months for them to really impact the economy. But we're seeing both the housing market and the corporate sector, which are the two key drivers, under a lot of pressure from these borrowing rates. But remember, nothing has broken down as of yet.
So you're saying these smaller companies, especially a lot of the unprofitable businesses, their stock price has plummeted and it's now going to cost them a lot more to borrow money.
Right. That's exactly right.
So the pressure is building.
The pressure is definitely building. And I don't know if you remember, almost a year ago, we already called for a recession based on yield curve inversion and some early evidence that we had. And now recession has become a completely mainstream call. So first off, the yield curve, the 2-year treasury over the 10-year treasury, when it inverts, probability of a recession really increases. Right now, we're at about a 50 basis point inversion, which is quite substantial. We'll cover more of the yield curve in a little bit later. Going here all the way back to the 1980s, inversion leads to recession within 18 to 24 months. Late 80s, early 90s, we get a recession in 91. In 2000, inversion leads to the dot-com recession. Inversion 2006, we all know what happened following that. We even had a little inversion right before COVID, which, curious enough, it's almost like a recession was bound to happen with or without COVID. It's almost like COVID actually helped delay it because it pushed demand forward with all the stimulus that happened. And sure enough, we're in a very, very severe inversion right now, as bad as 2000. Bloomberg probability of recession for the next year, that was in the news, almost at 100%, or just at 100%. This is their some of their newest models. And you can see that happened right at COVID and 2007, 2000. So probability of recession next year is now incredibly high. What's really interesting, that this almost caught me by surprise, is that even though the stock market is not down nearly as much as 08, it's down about half of what it was in 08 so far, at least. The total amount of wealth destruction as a percentage of GDP is roughly on the same level as 2008. And one of the reasons for that is that the destruction in the bond market that is being held by so many pensions, endowments, institutions, etc., has just been devastating. So the combination of equities, bonds, and other wealth destruction right now are absolutely massive. But yet again, nothing has so far broken down.
There's no safe haven, though.
There's no safe haven. Everybody's losing money in all the different places, but the economy was strong going into it, at least, stimulated to that level. So it's really going to be interesting to see how the next 12 months are going to look like, given the lag in which all this monetary policy is working on. Just something kind of curious. The other thing to consider is that when the CEOs are being surveyed, so typically they survey the CEO and they tell them, how confident are you in the direction of your business and the general economy? You can see that the CEO confidence levels now have gone below the COVID levels and basically close to 2008 levels. Basically, most CEOs are saying, yeah, there's going to be a recession and we're going to be setting up for it.
Surprised no one asked me, but I'd have to agree.
You should participate in that survey, right? It says Charles Schwab confidence, yeah, collaboration. I guess when Equi becomes a publicly traded company, the likelihood of that is gonna increase.
That's when they'll start giving us their ear.
Exactly. Earnings season, right? We talked about it. We've seen Amazon getting destroyed, Meta, Google, big tech names, even though markets did okay in October, but a lot of big tech did not. What we've seen is that when you missed on earnings this year, the stock price really got punished versus a relatively muted reaction on upside surprises. And that's, again, a feature of bear markets where when sentiment is so negative, you sell first and you ask questions later. And, we're seeing some of that behavior in the earnings as well. So the key question to everything, really, this is a $1 trillion question, is will the Fed pivot? Is the Fed going to stop? The last two rallies, we went back to that stock chart that we talked about earlier on. If we go back to it for a second. This rally here and this rally here were driven by hopes of a Fed pivot. Jackson Hole, Wyoming took place right around here, and then that totally crushed those hopes when Jay Powell said, no, there is no pivot. And here there was also some early hope for a pivot. This rally here, the catalyst was a Wall Street Journal article that came out saying the Fed may pause on interest rate increases. So with the common theme of these bear market rallies is the hope that the Fed is going to stop being so aggressive. So we really need to answer then the question, is the Fed really going to stop being so aggressive? And we'll try to answer that question now. So one of the more interesting charts that I've seen, what you can see here is so-called Fed funds futures, which is the expectation of what the Fed rate is going to look like. It's been incredibly correlated to stocks this year, as in interest rates have driven most of the price decreases. Here's that first hope for the pivot, and it was not reflected in the Fed funds futures at all. And similarly here, and similarly here. So odds are fairly high that if the Fed raises 75 basis points and doesn't hint at a more dovish move later on, that this rally is at really substantial risk of falling apart, just like the last two. So I would be pretty worried about that, and kind of see how that plays out and how Fed Day really plays out, and really the next 2 or 3 days after the Fed Day as well. But there is a chance that if the Fed does pivot, this line here is going to start shifting. So to really confirm risk assets going back up, you're going to need to see this line start shifting back here, which means more dovish tilt from the Fed. We haven't seen that yet.
Got it. So right now, the market's back to having hope, hoping for a pause, hoping for the pain to ease off. And we'll know around Wednesday if there's any intent on their side of slowing down. And your anticipation is that will dictate a lot of this current rally and where it ends.
Right, exactly. Okay. And I will also add to it, one of the main things we're looking at, when the main things the Fed is looking at, is inflation, right? That's really the key driver of everything, where the Fed is really stuck. They can't save the stock market as they have in the past. They can't print money. They have to be aggressive. Inflation is so high. This is really interesting, and we'll see if this plays out in the next few months, as if the idea that inflation is a monetary phenomenon, and we know that M2 money supply increased by close to 30% after 2020, 2021 to pay for COVID. This year, M2 money supply is really crashing. And CPI is a lagging indicator to M2 growth. So the question is, are we going to track this M2 money supply? This is a 16-month lag, so you can see how CPI overlaid by M2 at a 16-month lag has really tracked this. There is a real possibility that in 2023, CPI inflation is just going to completely collapse, and stagflation is going to turn into just pure deflation. But if that is the case, that means the Fed is behind the 8 ball yet again, because in 2021, they didn't raise rates as they should, and they kept printing money when inflation was already not, quote, transitory. Inflation was really picking up steam. And then towards the end of 21 and early 22, they just panicked and started raising rates very aggressively. So they were 12 months too late. One of the key questions I'm asking myself now is, are they too late again? The damage to the economy is being done as we speak, as we talked about the housing market, corporate credit, and all these kind of things. Are they basically raising rates into an already big slowdown that they just don't see because all the data is lagging? And that's really the key question into 23. If inflation really is going to fall apart, they keep raising interest rates now, it's not going to be pretty in 23 if that is the case.
Wow. And what's your gut tell you?
I think they're making a policy mistake. I think that I think they made a double policy mistake by being too loose in 21 and now probably being too hawkish now, leading to substantial issues down the line. What we have seen that's different from the last rally is that back then the Fed funds futures in white and the Fed dot plot, basically what the Fed members themselves think rates are going to be, were diverging, where futures were actually saying, no, Fed, you're not really hiking. The Fed said, yes, we are hiking. And then the Fed proved to the market that the market was wrong, and S&P fell 10-15% from there, bonds collapsed, etc. Right now, we're seeing a divergence between what equities were and even the Fed funds futures themselves. They're still showing both Fed dot plot and the market showing a Fed terminal rate of about 4.5%. So they're expecting rates to go to about 4.5% in 23. However, markets as well as the Fed are projecting a move back lower in 24. But here's where it gets interesting. Each dot represents a voting member of the FOMC and where they think rates should be. So right here is a little bit below 4.5. Here's a little bit above 4.5. You can see in 24 that the Fed is very much divided about what is going to happen. And I think that type of division within the Fed could lead to a lot of policy uncertainty that could lead to even more volatility, because this is really, again, unprecedented times.
Well, look at this lone soldier calling for over 4.5 and 25.
Right. You always have. I can probably guess who that is. They have super hawks and a few doves in the Fed, but long term, everybody kind of wants it to be back at 2.5%. That's the inflation target. Hopefully that would be the case, and we're not going to end up at the zero line in 2024, which could be the case. You can see that here too. Fed funds futures projecting roughly around May of 23, and afterwards rate cuts following from May 23. So Fed fund futures telling you right now Fed's going to hike us into a recession that's going to actually force them to start cutting rates around middle of next year.
We'd have to be in a lot of pain for that pivot to happen that fast.
It seems to be possible. But going into Wednesday, as of today, Fed funds futures are putting an 86% probability of a 75 basis point rate increase again.
It does not bode well for that rally you were pointing at earlier.
Right. It's really going to be about what they say about December and the following year that the market's going to pay more attention to, because it does seem like the 75 basis points now is a lock. So really what to pay attention for is the potential pivot, 50 or 75 basis points. My guess, if they do raise 50 basis points, risk assets are gonna go through the roof, because that would appear as if the Fed is stopping. Probably not going to happen, but definitely something to watch for. And then obviously the key question is a pivot actually bullish for the markets or not? Because that's another thing. In the short run, it appears obvious, right? Everybody's excited that the Fed is pivoting, and we can have a big rally in risk assets. But I would say be careful what you wish for. 1997 to 2002. So that's the S&P 500, and that's the Fed funds rate. And when the Fed paused raising rates here, markets did go up a little bit more. But then as the Fed lowered rates, markets continued to fall all the way until 2002. It's very counterintuitive, right? You would think, but the Fed is lowering rates, why are markets going down? And it goes back to that lagging effect. If the Fed is lowering rates, that must mean that a lot of damage has been done and the economy is really slowed down. Corporate earnings are collapsing, really bad things are happening, and therefore markets did fall with the Fed funds, and just after that period they started rebounding. The 2008 bear market, very, very similar phenomenon. Right here, Fed raises rates, Fed pauses, and markets did go up between June 2006 and October of 2007. But when the pause turned into cuts, markets also collapsed all the way to 2009. So even though a Fed pivot or a pause could be bullish for the short run, as it was in 2006, I just say be careful what you wish for. When the cuts start, that means that a lot of damage may have already been done.
Funny, I actually remember you telling me this in, I think it was even actually in 2020, where you were explaining, you were like, hey, everyone's afraid right now of rate increases, but you're like, that's not the thing to be afraid of. it's like the thing to be afraid of is when the Fed pivots, because that tells you something's really maybe something's gone wrong, right? Like that's
Right.
we're in for a lot of pain. It's kind of like a car when you hit ice and you go once to correct, and then you realize you've overcorrected and you go the other direction, and now your tail starts sliding out.
Which makes you wonder why we let a group of individuals in a room make all these decisions. But that's, I'm not here to debate policy.
That's right.
So how do you play the pivot? At the end of the day, we can talk about it, but the goal of everybody here is to make some smart decisions in our portfolio. And I'll give you one idea that I don't recommend or approve, but it's just an idea that I throw. We talked about the yield curve. So what is that yield curve? The yield curve is the spread between the 2-year treasury and the 10-year treasury. So the idea here is that during normal periods of time, the 10-year treasury is going to yield more than the 2-year treasury. It's simple, right? If you're willing to lock your money for 10 years and lending money to the government for 10 years, you should be compensated with a higher rate for that. If you're willing to lock your money for 2 years, typically the rate is going to be lower. That's just how normal things look like. However, ahead of a recession, something interesting happens. The short-term rates pay more than the long-term rates. And why would that happen? That happens because investors start believing that if a recession is going to come, that rate on the 2-year is going to drop back towards zero, or is going to go back lower, not necessarily zero, but definitely is going to go lower. So within 2 years, they're going to have to roll it again, and the next 2-year notes are going to be priced much lower. So it's better for them to lock their money for 10 years, and therefore, even if the 2-year yield pays more, they at least secured 10 years worth of the higher coupon. That's the thinking. What's really interesting about that is it almost becomes a self-fulfilling prophecy, because an inverted yield curve really hurts the banking system. Because if you think about it, what's the business of a bank? Like, what does a bank do for a living?
They make mortgages, long-term loans.
But they borrow from the short term, right? They borrow from the checking accounts, and then they lend in the long run. So yep. They're not obviously paying the Fed funds rate to customers on checking accounts, but ideally in an inverted yield curve, their borrowing costs are higher than what they're making lending it out. So an inverted yield curve slows down the financial system because banks want to make less loans. And then it becomes a self-fulfilling prophecy because there's now less liquidity in the system. So typically that inverted yield curve leads to a recession. We talked about early 1980s. Late 1980s, late 90s, this is 99 to 2000, and this is 2006. These were all inverted yield curves. And then typically when the recession starts, it flips back because the short-term Fed funds rate are reduced lower. And the expectation is that an economic recovery is going to take place at some point, and therefore the long-term yields pay more. Very simple. Very simple idea. It's unlikely that the inversion is going to go as low as the early 1980s, because rates then were way, way, way higher in percentage terms. You're talking double digits on the 10-year. So we really had 1, 2, 3, maybe 4 such opportunities over the last 40 years or so. So it comes about once a decade. But you can play the steepening of this yield curve, meaning that you can buy the 10-year treasury and you can short sell the 2-year treasury and basically capture that steepening. It always goes back to around 200 basis points plus, or has in the past. That's sort of the range. And you can see, unlike the stock market or other things that are more volatile, the move is fairly straightforward. The risk at these levels of negative 40 basis points is relatively low. And doing so could be a really interesting trade as a way to play for a potential pivot without taking the risk of the equity markets.
Clever. See what you did there. So again, not investment advice. How do you think about, for someone who's not looking to go be an active trader, how do you think about portfolio positioning just generally?
Yeah, so I think a portfolio positioning for really the next in my opinion, the next decade needs to have a lot more of what you're seeing here. So more tactical, more unique investment strategies, non-correlated strategies in a way that really reduces the beta and isolates you against some of these shocks. Because even when you're seeing with these bear market rallies, catching 8 or 9% rally, then needing to step aside, then the market keeps moving, could be very complicated. So diversification across strategy and unique return drivers is a great way to position. And I really believe that would be the next decade. The next decade is probably going to be a lot of volatility, as we've seen as central banks move away from fueling consistent liquidity into markets. I think volatility is the new norm.
Well, on that cheery note, fitting for Halloween, are there any last thoughts you want to leave with the investors watching this call today?
Yeah, let's talk about why the Fed is stuck and why a pivot is inevitably going to happen. I think it is important to kind of understand the general macro and the bond market specifically. I know a lot of people don't pay as much attention to the bond market, but they really should, as it is the most important market in the world, in my opinion, very large as well. And really, bonds have been in an epic bubble. We all talk about the 60-40 portfolio. Again, White goes back to 60-40 is not what it used to be. 60-40 was fantastic when rates were 12%, even when rates were 8%, right? There's a lot of room for them to fall. Bonds are stabilizing, etc. But when rates fell to zero in 2019, 2020, a bubble at just epic proportions was formed. There were $18 trillion of negative yielding bonds in the world around that time. That was peak bubble. Now there's almost nothing, besides maybe in Japan. We'll talk about that in a second too. And imagine, instead of getting paid to invest in bonds, you would have to pay the government for the privilege of storing your money, which was really the case in many, many countries. And any normal investor would be, well, you know, that just can't last. And sure enough, our economy is also highly levered. So first off, in 2008, we saw a huge expansion in the monetary base when zero rates were enacted for the first time. That's really 2008. Here you see the 3-month treasury rate going to zero and debt exploding, because why wouldn't you take a lot of debt when you're not paying any interest on it? And then COVID saw it really going to the other extreme when, or to the same extreme, but really they pushed the envelope with COVID, printing almost 30 cents on any dollar and putting rates right back at zero. So what that creates is a situation where, as the interest rates continue to decline, the debt to GDP continues to rise. And even today, we are at negative rates when adjusted for inflation, right? Because even if the rate is 4%, but inflation is 8%, you're still technically 4% behind, even in a treasury bond. And you know, last time we've seen that during the 70s and early 80s, but it's not really that common. But it really has been the case since 2008. You know, yields are artificially low. And quantitative tightening is causing a lot of liquidity issues. Not only that the Fed is actively selling bonds, but also the foreign holdings of bonds at the Fed continues to drop as the dollar is increasing, because as the dollar increases, other countries need to sell their US bonds in order to get dollars to stabilize their currency. So what's going on around the world is this gigantic liquidity suck. And lastly, when you're looking at the past 4 decades, the increases in debt were offset by lower and lower rates. So again, nobody felt it, because every time you add an incremental amount of debt, the rates are just lower and lower. So your payment's not going up. Your payment's actually going down even. But this is the first time in decades that we're seeing an increase in rates while the debt level is still really, really high. And what that means for the federal government and potentially your taxes is a very toxic combination. Increasing in debt while increasing interest rates at a 3.5% rate alone means that the government may have to pay $1 trillion a year just to pay the interest on the debt, which will make the debt the largest item in the federal budget, more than Social Security. So to me, that's just a recipe for a lot of volatility in the next decade.
Got it. Okay, so this is the rationale behind that, your anticipation of a very volatile remainder to the 2020s.
That is exactly right. And at the end of the day, it's just one bottom line, right? It's becoming much harder to borrow from the future when rates are higher. So again, putting that $1 trillion number in perspective at 3.5%, in 2022, the US government is expected to bring in $4.9 trillion. Imagine spending $1 trillion of that just servicing the debt.
Wow.
And that continues to grow as there's no balancing in the budget. And to put that in perspective, US total debt to GDP is 900%. So what's total debt? It's not just the federal government debt. When you're talking about consumer debt, individual debt, corporate debt, federal debt, state debt, you put it all together, that's your true debt number. And you can see, it went from just under 800% to 900%, and that has been increasing consistently as the economy is becoming more indebted. Interestingly enough, though, on the global stage, the US is doing relatively okay. This is, for example, Japan, but over 1,300% total debt to GDP. And some interesting quirks are going on there when the Japanese central bank, just as an example, literally can't allow interest rates to go up because they just have too much debt. So they're still printing money in order to reduce the yield on their bonds. They still keep the short-term rates at negative, and they're basically buying all the bonds across all the maturities to keep, let's say, their 10-year rates from going above 0.25%. They literally can't afford it. If it goes above that, they would not be able to serve the debt. Which is why you're seeing all these interesting phenomena that are taking place in the yen and other things like that.
And this is happening in real time, just so people are aware.
This is happening in real time. It's one of the most interesting times in my career. That's definitely true. We're seeing diverging monetary policies. For example, here, what you're seeing is the spread between the US 10-year rate and Japan. Japan's at 0.24. The US is over 4%. The interest rate differential is right around 4%. That's putting tremendous pressure on Japan when they, for example, need to print yen in order to buy the bonds during quantitative easing to basically keep interest rates artificially low, but then the yen keeps depreciating. So the yen started the year close to 110, now it's around 150. And as that's happening, speculators are piling in, selling more yen, realizing Japan has to print more yen. But then Japan's trying to keep the yen from going too low. And the only way for doing that is spending US dollar reserves to buy the yen. And they're holding a lot of US treasuries. They're one of the largest creditors that hold US treasuries. So they keep selling US treasuries, which makes our interest rates go even higher to keep getting dollars, to keep propelling the yen. But as that's happening, that's putting more pressure on them because the difference between the US and Japan keeps increasing. So it's just fascinating how that's working in real time right now.
So this creates a real possibility that we might see a sovereign default.
Yeah, I mean, that's kind of the when I said in the beginning of the call, things may break down. I mean, this is within the realm of possibility. Now, again, I don't think it's likely, but it is possible. So not necessarily likely because I think that you will see intervention ahead of that. I think that if we were getting close to a situation like this, that would be enough for the Fed to pivot because they would not allow a country like Japan to get into that level of trouble because that would be catastrophic for the world's economy, which all these things are basically saying that the likelihood of a Fed pivot is high. I don't think that they can allow interest rates to be this high for too long. without having major consequences to the global economy, which is why I do think we're going to see the pivot probably in the next 2 to 4 months.
It's wild. Everyone fixates on the home front, and they're like, "Oh, the Fed needs to keep their eyes, make sure that the economy is doing all right." But the reality is, the ripple effect is substantial throughout the entire financial system, global financial system.
And we didn't even start talking about Europe and energy costs and their recession. So yeah, again, on a relative basis, the US is doing just fine, which is also why the dollar, one of the reasons the dollar is a safe haven nonetheless. And now with US bonds being relatively attractive, that may also put a low into the bond market in the next few months. So I do think 2023 will be different than 2022, but volatility is definitely here to stay.
All right, is that it? Did we arrive at the end of this?
That's it.
Wow.
If there's any questions, feel free to email.
Quite the tour de force. We covered everything from policy at home to policy in Japan, debt servicing costs, the impact on the stock market. I always appreciate these tours of markets. A lot going on, a lot to keep your attention on, and so appreciate you doing the hard work. So a lot of the rest of us don't have to.
Anytime. I enjoy it. Any questions? founders@equi.com. Look forward to answering your questions, and enjoy. I guess October is almost done and 2022 is almost done. So let's see how the year ends up. Let's see what the Fed says on Wednesday, and we take it one day at a time.